And as you recall, in Chapter 8, we were talking about long-term investments, and we wanted to touch on some very important time value of money concepts. So first we want to start off with how to analyze and report controlling interest in other corporations using the consolidated financial statements. So companies buy a significant stake in other companies in order to influence the other company's operations. In this section, we cover a situation in which a corporation buys enough of another company to actually control that company. Most large corporations own controlling interest in other companies. The controlling or majority interest is the ownership of more than 50% of the investee's voting stock. Such an investment enables the investor to elect majority of the members of the investee's board of directors and thus control the investee. The investor is called the parent company, and the investee is called the subsidiary company. This diagram just provides a visual picture of the parent-subsidiary relationship. So here we see that we have many investors who are the stockholders who own the parent corporation. The parent corporation is a separate legal entity, holds ownership of the stock in the subsidiary corporation. Consolidated accounting is a method of combining the financial statements of all the companies controlled by the same stockholders. This method reports a single set of financial statements for the consolidated entity which carries the name of the parent company. Consolidated financial statements combine the balance sheet, income statements, and cash flow statements of the parent company with those of its subsidiaries. The result, again, is a single set of statements as if the parent and its subsidiaries were one single company. Investors can gain a better perspective on total operations than they could by examining the reports of each of the subsidiary companies. In consolidated statements, the assets, liabilities, revenues, and expenses of each subsidiary are added to the parent's accounts. The process of consolidating the parent and subsidiary accounts involves using a worksheet to add together individual balances. Any intercompany accounts, such as loans between companies, revenues between companies, are eliminated in the process. The financial statements of the subsidiaries may not be available to the general public in some cases. Goodwill and non-controlling or minority interest are two accounts that only a consolidated entity can have. Goodwill is the intangible asset that represents the parent company's excess payment over and above the fair market value of the assets to acquire the subsidiary. You'll recall we talked about goodwill as an intangible asset in Chapter 7. Non-controlling or minority interest arises when the parent company owns less than 100% of the stock of a subsidiary. The remainder of the subsidiary stock not held by the parent company is the non-controlling or minority interest. This non-controlling interest is reported as a separate account in the stockholders' equity section of the consolidated balance sheet of the parent company. The amount of non-controlling interest in subsidiary stock must be clearly identified and labeled as such. And so this table shows the different accounting methods used for long-term investments. And you'll recognize this idea of available for sale. And we'll talk about equity, consolidation, and an amortized cost. So most countries use their own national currency. An example is the European Union nations. France, Germany, Italy, Belgium, and others use a common currency, the euro. So if a U.S. company sells products in France, will it receive dollars or euros? If the transaction is in dollars, the company in France must buy dollars to pay the American company in U.S. currency. If the transaction is in euros, then the U.S. company will collect euros and must sell euros for dollars. The price of one nation's currency can be stated in terms of another country's monetary unit. The measure of one currency against another is called the foreign currency exchange rate. We can convert the cost of an item translated in one currency to its cost in a second currency. We call this conversion a translation. Two main factors affect the price or the exchange rate of a particular currency, and that is the ratio of a currency's imports to its exports and the rate of return available in the country's capital markets. Japanese exports often exceed Japan's imports. Customers of Japanese currency must buy yen the Japanese unit of currency, to pay for their purchases. This strong demand drives up the price of yen. In contrast, the United States imports more goods than it exports. Americans must sell dollars to buy the foreign currencies needed to pay for the foreign goods. As the supply of dollars increases, the price of the dollar falls. The rate of return available in a country's capital market affects the amount of investment funds flowing into the country. When rates of return are high in a politically stable country such as the United States, international investors buy stocks, bonds, and real estate in that country. This activity increases the demand for the nation's currency and drives up its exchange rate. Currencies are often described as strong or weak. The exchange rate of a strong currency is rising relative to other nations' currencies. The exchange rate of a weak currency is falling relative to other currencies. The process of translating a foreign subsidiary's financial statements into dollars usually creates a foreign currency translation adjustment. This item appears in the consolidated financial statements of most multinational companies and is reported as part of other comprehensive income. A translation adjustment arises due to changes in the foreign exchange rate over time. In general, assets and liabilities are translated into dollars at the current exchange rate on the date of the statements. Stockholders' equity is translated into dollars at older historical exchange rates. Paid-in capital accounts are translated at the historical exchange rate when the subsidiary was acquired. Retained earnings are translated at the average exchange rates applicable over the time period in which interest in the subsidiary has been held. The difference in exchange rates creates an out-of-balance condition on the balance sheet. Use of the translation adjustment brings the balance sheet back into balance. And so now let's talk about reporting investment activities on the statement of cash flows. So this table summarizes how investment transactions would be reported on the cash flow statement investing section. So purchase of available for sale investments would represent an outflow of cash. Sale of available for sale investments, an inflow. Purchase of the equity method investments, an outflow, and then sale of equity method investments, an inflow. So this learning objective is to explain the impact of the time value of money on certain types of investments. The term time value of money refers to the fact that money earns interest over time. Interest is the cost of using money. To borrowers, interest is the fee paid to the lender for the period of time. To lenders, interest is the revenue earned from allowing someone else to use our money for a period of time. Whether making investments or borrowing money long term, we must always recognize the interest we receive or paid. Otherwise, we overlook an important part of the transaction. The difference between your original investment and the future value of the investment is the amount of interest revenue you will earn during the year. Interest becomes more important as the time period lengthens because the amount of interest depends on the span of time the money is invested. The time value of money plays a key role in measuring the value of certain long-term investments as well as long-term debt. The term future value means the sum of money that a given current investment will be worth at a specified time in the future, assuming a certain interest rate. The difference between your original or the present investment and the future value of the investment is the amount of interest you will earn during the year. To calculate the future value of investment, we need three inputs: the amount of initial payment or receipt, the length of time between the investment and future receipt or payment, and the interest rate. So often a person knows or is able to estimate a future amount and needs to determine the related present value. So what is that future amount we're going to receive worth in today's dollars? The term present value means the value on a given date of a future amount or series of future payments discounted to reflect the time value of money. Like future value, present value depends on three factors: the amount of payment or receipt, the length of time between the investment and future receipt or payment, and the interest rate. The process of computing an interest value is called discounting because the present value is less than the future value. Figuring present value by hand for investments spanning many years is time-consuming and presents too many opportunities for arithmetic error. Present value tables simplify our work. Using a computer program like Microsoft Excel provides an infinite range of interest rates and periods. And so for that reason, most business people tend to solve present value problems quickly and easily using Excel and not tables. And then we have financial calculators, which also provide us with a somewhat easy way of going about solving these problems. Some investments provide the investor with only a single future receipt. Annuity investments provide multiple receipts of an equal amount at fixed intervals over the investment's duration. The present value of a bond, its market price, is the present value of the future principal amount at maturity plus the present value of the future stated interest payments. The principal is a single amount to be received by the investor and paid by the debtor at maturity. The interest is an annuity because it occurs periodically. So let's say that again, that if I'm trying to calculate the present value of an investment in bonds, I calculate the present value of the future amount that I'm going to redeem the bond at, plus I calculate the present value of the stream of interest payments that I'm going to receive as a result of holding the bonds over that time. The sum of those two gives me the present value of investments in bonds. And so this concludes Chapter 8, even though this says Chapter 10. And so I encourage you to go back and read the chapter again and to make sure you're comfortable with the concepts, and then to go ahead and complete the learning exercise accompanying the chapter. And thanks very much. We'll go on to Chapter 9 in the next presentation.